You look at the BlackRock State Street SLV scam ETFs, as far as I'm concerned, it's funny. SLV and GLD are run by JP Morgan and BlackRock. JP Morgan, who paid a $920 million fine for manipulating the metals market. But their prospectuses say that because of the demand, there can be an inequity. There can be a time where there's not as much metal in the system as there are bars behind it. But in general, yes, that is exactly what is supposed to happen. Now, the Sprott Physical Trust is anything but a scam. SLV and GLD, I wouldn't put my money in to save my life. And if you doubt me, read pages 6 through 12 titled Risk Factors. Really read it slowly. And I think you'll come away saying, whoa, I don't want to own that. Like, for example, in London, they have a 140 million ounce float, yet they're trading 600 million ounces a day in contracts that technically are deliverable. What could possibly go wrong? There's over 2 billion ounces in paper claims out there on a float of 140 million ounces. So that's exactly what it is. It's a situation where the paper promises, this rehypothecation, is being called on the mat. And you can see that. Look, for example, the lease rate in silver in London, when you lease silver in London, it would be something like you want to short a contract. You want to short the price of silver, but you don't have the metal. So you have to borrow metal through leasing it in order to deliver the metal, to drive down the price. Normally that lease rate is somewhere in the neighborhood of 0.5% or 1%. In October, it's jumped up over 39% to over 39%.
Wow.
And at the same time, we've seen silver rise since August, when the lease rate was at about 1% or so, up to $53 here. So you see the price rising, the lease rates rising. We're seeing the exact same thing in platinum, but it's a situation where right now you have the spot market trading well above the futures price. In other words, buyers are very desperate for immediate delivery. And it's very rare to see this, Adam, in silver. Yeah. It's very rare. It signals urgent demand, depleted inventories, and really a systemic shortage of deliverable bars. And that's all because of rehypothecation. In other words, it's getting called onto the carpet.
A clear sign of that stress: the lease rate in London for borrowing silver, the cost for a short seller to secure actual metal, has soared. Where it might normally be under 1% annually, recent episodes have seen rates spike above 30% in some periods. That jump signals desperation. Short sellers scrambling to cover positions by physically acquiring metal. Simultaneously, the spot price of silver has broken above US $50 an ounce, reflecting urgency. And while some relief has recently arrived via shipments, the root physical shortage remains critical.
You're seeing delivery stress on that is exacerbating it on COMEX. We've already seen 16.5 million ounces delivered in COMEX, adding to the limited vault supplies. But yes, the main stress is in London right now, and much more so than on COMEX. And really, it is, in my mind, the epicenter of where all of this could really get into some serious problems, where you're beginning to see margin calls for traders out there who are receiving a margin call because the price is going against their short position, and the lease rate and the borrowing costs are so high that they're not able to get the silver to cover their position. And that's when things begin to get very, very, very interesting. What it really tells us is that buyers aren't just rolling over their contracts like they used to. They're standing for delivery. They're demanding real metal. And these delivery numbers are well above normal. So I guess if you could encapsulate it easily, it's that the rush for gold and silver is real. It's intensifying. And markets just aren't trading paper contracts right now. The people want the real metal in hand. And in a world where paper contracts are vastly overstating the supply, that becomes a problem.
Markets typically trade in contango, futures prices higher than spot because of storage and financing costs. But when spot outpaces futures, a condition called backwardation, it's a red flag. In silver's case, the spot market is trading above futures, buyers insist on immediate delivery, and inventory chains are being strained. That tells us the market is not simply expecting future scarcity, it's acting on today's shortage. With rising premiums, wide bid-ask spreads, and physical metal harder to source, the infrastructure of paper trades is under stress.
Absolutely. The short-term implication would be liquidations and survival-driven selling can trigger volatility. That's the short term. Even sharp pullbacks. Medium term, as far as I'm concerned, is that once this forced selling ends, the physical scarcity starts to dominate. And silver sustains its higher prices, $50 plus. But long term, if confidence in this paper system collapses, like we're seeing, a structural reset could start to reprice silver. That's what I'm seeing. $75, $100, and I say that to you, and that's not pie in the sky, because if you take the 45-year cup and handle that goes like this, the way technical analysis works is the top of the cup 1980, the bottom of the cup the early 90s, and again back up to 2011 again, which is near the top of the cup, and then formed another. It's a double cup and handle, but the way that it works is once silver has broken through 50, which it has, technical analysis would say you take the distance from the bottom of the top, which was $46, from 50 to 4, and you add it to the top. That would mean that the next target from a technical analysis standpoint is $96. And I think that's exactly what you will begin to see, where the market physically begins to exert itself over the paper shenanigans that we've seen for a long, long time. The United States for the last 40, 50 years has bet on a strategy of strong dollar and U.S. bonds and service jobs, where the rest of the world, in particular the BRICS and China, have, have not been ignoring the factories like we have not been ignoring commodities like we have. China, as a good example, did the opposite. It built factories, accumulated commodities and gold, and now is really pushing away from relying upon the dollar. That is ultimately, I think, where we're going. Yes, exactly that, right there.
In the near term, the mismatch between paper claims and physical metal could trigger liquidations, forced selling, and sharp pullbacks. These moves might spook casual investors. But looking ahead, once forced sellers exhaust themselves, the physical shortage begins to dominate. In that stage, as actual bullion becomes the constraint, higher sustained prices are likely. Some analysts now foresee silver remaining above US $50 an ounce, perhaps climbing into the 60s or beyond. The key shift from trading contracts to owning real metal.
Ours aren't that high, but you are beginning to see premiums start to blow out. And even worse than that, what you're going to see is a massive spread between buy and sell, because it's narrowed a bit to about $1.80. But yesterday and the day before, we were about a $3 spread between the futures price and the spot price. Mm-hmm. So let me explain what that really means. If I'm going to buy 100,000 ounces of silver, and the spot price says $52, but I'm not able to hedge it on the futures contracts and anywhere near that price, it's actually $48 that I can hedge it at. That's what the futures market is. This is backwardation. In other words, where the futures price is lower than the spot price. It's very, very unusual. Normally, it's called contango, where the spot price is X and the futures price is X plus 1, plus 2, plus 3. The further you go out, the more you're supposed to pay for the time value added of money. It's like if I loan you money and you're going to pay me back tomorrow, I probably won't charge you interest. But if I loan you money and you're going to pay me back in 6 months, well, I probably am going to charge you interest, kind of thing. Well, that's exactly what contango would be. That's a normal market. The backwardation is the opposite of that. So for dealers who have to buy metal at X, they can't hedge it anywhere near X. It's X minus 3. So you're exposed. There's a big spread between buy and sell, and the premiums are jumping noticeably on the Eagles. And this is exactly what we saw during the pandemic. The premiums on Eagles, every major dealer in America right now is north of $6, $7, $8 an ounce over spot. Just like that. Mm-hmm. I've been screaming to everyone for the last year and a half that it's very unusual how low the premiums have gotten. And now the U.S. Mint, which once again is the model of inefficiency, is not able to keep up. Gold buffaloes, right, as an example, gold buffaloes, our cost on gold buffaloes is north of $200 over spot. Our cost before we make a penny. Right now, the biggest distributor, one of the biggest distributors in America, who I do a lot of business with, their cost on selling me Silver Eagles, if I buy massive amounts, will be north of $6 over spot. That's before I make a penny. They have no platinum, zero in stock. These are massive wholesalers that trade in the billions of dollars. per year. We're beginning to see a system where, the paper versus physical divide is breaking. The credibility of paper, silver, and gold and platinum futures, especially unallocated accounts, is
Right.
eroding as more and more players demand physical settlement, and that's going to exert itself in the premiums that you see in the retail market. It's becoming much harder for dealers like myself to balance that. Not only is there a lack of liquidity, but you have this huge spread between futures and spot, so it's hard to hedge your position.
Deep beneath the immediate market turmoil lies a larger tectonic shift. Many Western economies have built their financial systems around strong currencies and service sectors, less so around commodities. Meanwhile, countries such as China and India have been accumulating resources, including precious metals, and are reducing reliance on the U.S. dollar. As confidence in paper-based systems erodes, assets like silver could undergo a structural revaluation. Instead of being just a tradable commodity, silver may increasingly be viewed as a strategic store of value. The potential upside? Much higher price targets and reset market norms.
I will tell you that the demand at a level of sophistication that you speak to, the people who you speak to, I would say are far more sophisticated than many of the financial advisors that they would work with mainstream, because they understand the big picture, right? You go to a financial advisor who might be the best in the business, but doesn't acknowledge that the world is the way that all of us think it is. The macro picture, the geopolitical picture, which is so very, very important to understand if that's going to be the backbone of advice that you're given on your portfolio. So I guess all I can simply say to you is that most people are going to be caught off guard by this. And it will go from an environment of high prices that will identify the market to most people, to your people saying, geez, I can't get it easily. It's disappearing. And just like that, it will disappear. So while things are good right now, look, let me put it to you this way. Goldman Sachs said, if the market even suspects for a moment that the Fed is losing independence and 5% of the money that's embedded in Treasury shifts to gold, the price will go parabolic, will go well north of 5,000. It's going to go well north of 5,000 because Stephen Mirren is the architect of the Mar-a-Lago Accord, and he is now on the Fed. He was Trump's big advisor. Or even this Bo Hines, who was Trump's crypto advisor. He's now running USA Tether, which is backing the Genius Act. There is no independence. The market is going to catch on. The big money is catching on. The rest of the money will too. And then getting product will be very difficult because we've gone a year without any of these wholesalers or refiners or big importers finding much need to go deep into their lines of credit to secure product because there wasn't any need to. I knew there would be. And whether I was stupid or lucky, I'll tell you that there are very few companies out there that have the inventory that we do right now.
Unlike gold, much of silver's supply is a byproduct of other mining activities. Primary silver mines are rare, and output growth has been weak. Meanwhile, industrial demand for solar panels, electric vehicles, electronics is booming. Global silver production has run in deficit for multiple years, and above-ground stocks are shrinking. At the same time, investor interest in real metal, not just paper exposure, is intensifying. The result? A possible once-in-a-generation moment where the market for physical silver overtakes the conventions of paper trading. For investors, this means reassessing assumptions and existence of physical delivery.
You look at the BlackRock, State Street, SLV scam ETFs, as far as I'm concerned, it's funny. SLV and GLD are run by JP Morgan and BlackRock. JP Morgan, who paid a $920 million fine for manipulating the metals market. But their prospectuses say that because of the demand, there can be an inequity. There can be a time where there's not as much metal in the system as there are bars behind it. But in general, yes, that is exactly what is supposed to happen. Now, the Sprott Physical Trust is anything but a scam. SLV and GLD, I wouldn't put my money in to save my life. And if you doubt me, read pages 6 through 12 titled Risk Factors. Really read it slowly. And I think you'll come away saying, whoa, I don't want to own that. Let's not forget that, for the last 5 years in a row, we've had between 1 and 200 million ounces short in supply versus demand in mining with silver. So you have a declining availability of supply. You have an increased demand in silver, not just for its monetary aspect, like we're talking about, but it's things like military, it's things like electric vehicles, it's things like
Mm-hmm.
solar panels. This plurality in demand is very unusual in the commodity, and silver exemplifies it. So on top of an expansion in demand, you have a decrease. Silver is found in nature like your skin is epidermis. It's found in a form called epithermal right near the surface. The big deposits are declining and disappearing. Only about 20% of the silver mined last year, about 170 million of the 850 million came from mining companies like First Majestic. The rest of it is byproduct of
Right.
other mining. It's disappearing in nature. So yes, this is a once in a generation, I believe, shift into an asset that has been controlled by the West forever on leveraged futures contracts that is being exploited and understood by the rest of the world. And we're beginning to see it manifest. Now, this may not be that moment, but in my mind, it is moving towards that moment.